Interest rates, which are determined by central banks, have a significant impact on the economy as a whole. Nonetheless, their effects on the economy are frequently delayed for a variety of reasons before they become apparent. We shall discuss it in detail in this video. Make sure to subscribe to our channel before we start. One factor that influences monetary policy, including interest rate adjustments, is the delayed effect. The transmission of interest rate adjustments from central banks to various sectors of the economy requires a duration of time. For instance, companies might not respond to a reduction in interest rates with an immediate expansion of operations or investment in novel undertakings. A similar pattern may occur when consumers' expenditure does not increase immediately in response to decreased borrowing costs. The adjustment period is a crucial duration during which economic agents, including households and businesses, need to modify their actions in accordance with fluctuations in interest rates. For example, organizations might require additional time to assess the viability of novel investment endeavors or to reorganize their financial agreements. Even after interest rates decline, consumers may choose to delay significant purchases, such as automobiles or residences. Contracts and commitments. A considerable number of economic transactions are regulated by pre-existing agreements or commitments that are not amenable to short-term modifications. For instance, predetermined interest rates on fixed-rate mortgages remain constant for a specified period of time, notwithstanding fluctuations in market rates. Likewise, fixed interest rates may be applied to long-term business loans, thereby mitigating the immediate repercussions of monetary policy adjustments. Expectations and uncertainty. Economic agents frequently make judgments regarding interest rates and other aspects of future economic conditions based on expectations. Potentially anticipating additional interest rate fluctuations, they might postpone their reaction to ongoing rate adjustments. Furthermore, apprehension regarding forthcoming economic circumstances may induce prudent conduct, thereby attenuating the immediate impacts of fluctuations in interest rates. Transmission mechanisms. The intricate and diverse transmission mechanisms are responsible for the impact of interest rate fluctuations on the economy. For instance, while reductions in interest rates might initially invigorate demand in interest-sensitive industries such as housing and durable products, it could take some time for the complete repercussions on inflation and employment to become apparent. In the same way that increased interest rates may initially deter demand, they may ultimately result in greater savings and diminished inflationary pressures. External factors. A multitude of external factors exert an impact on economic conditions, encompassing geopolitical events, financial market fluctuations, and worldwide economic trends. The interplay between these external factors and interest rate fluctuations may amplify or counterbalance their impacts on the domestic economy. Most of the time, inflation and interest rates move in the same way. This is because the U.S. Central Bank controls inflation mainly through interest rates. The Federal Reserve Act tells the Fed to work toward full employment and stable prices. As part of its dual mission to keep prices stable, the Federal Reserve has been aiming for an annual inflation rate of 2% since 2012. The Federal Reserve wants to see a positive rate of inflation, which means that prices for goods and services keep going up. This is because prices going down for a long time, which is called deflation, can be even worse for the economy. The fact that both inflation and interest rates are positive also gives the central bank the freedom to lower rates if the economy starts to slow down. The Federal Reserve switched to average inflation targeting in August 2020. This plan told Fed officials that they would keep inflation above 2% for a while to make up for times when it didn't meet that goal. How the Fed figures out how much inflation there is. The Federal Reserve likes the Personal Consumption Expenditures, PCE, price index as a way to measure inflation. The PCE price index tracks prices and consumer spending by looking at business receipts, which are used to figure out the gross domestic product, GDP. This is different from the Consumer Price Index, CPI, which is based on a poll of what consumers buy. There is a number from the PCE price index that is called the Core PCE Price Index. This doesn't include prices for things like food and energy, which change more often and don't always show the general trend of prices. How changes in interest rates affect the cost of living. When the Federal Reserve raises its standard federal funds rate in response to high inflation risks, it effectively raises the level of risk-free reserves in the financial system. This reduces the amount of money that can be used to buy riskier assets. When a central bank lowers its goal interest rate, on the other hand, it makes more money available to buy risky assets. Rising interest rates make it more expensive to borrow money, which makes people and businesses less likely to spend. This is especially true on big-ticket things that are usually financed, like homes and capital equipment. When interest rates go up, asset prices usually go down too. This cancels out the wealth benefit for individuals and makes banks more careful about lending money. Lastly, rising interest rates make it more likely that the central bank will keep tightening monetary policy. which makes people even less optimistic about inflation. There are issues with relying on interest rates to manage inflation. It takes time for policymakers to react to changes in the economic outlook, as shown in the chart above. It also takes time for policy changes to have an effect on inflation rates. Because of these delays, officials have to try to guess how inflation will change in the future when they decide what rates to use now. But the only way to tell if the Fed is sticking to its inflation aim is to look at inflation data from the past. There is a wide range of these during economic shocks that are sometimes short-lived and sometimes not. According to Ben Bernanke, former chair of the Federal Reserve, monetary policy is like driving a car with an unreliable speedometer, a foggy windshield, and a tendency to respond unpredictably and with a delay to the accelerator or brake. Bernanke said this in 2004 while he was still a governor of the Federal Reserve. If central banks try to guess how inflation will move, they might make a policy mistake and either make inflation worse by keeping rates too low or slowing growth by raising them. For the Federal Reserve, its goal is to keep prices fixed while also trying to get as many people working as possible. As a tool for monetary policy, interest rates are used. The federal funds rate is the main tool that the Federal Reserve uses to set monetary policy. Since 2008, the federal funds rate has been aimed at a range. It is the rate at which banks give money to each other overnight. In the past, the Federal Reserve changed the amount of reserves held by banks and kept the federal funds rate steady through open market operations, which meant buying and selling assets. The need for reserves came from the fact that banks had to keep certain amounts of reserves on hand to make sure they were safe. After the global financial crisis of 2008, capital buffer requirements and stress tests became the main focus of bank regulation to make sure that banks would be able to pay their bills in the long run. The Federal Reserve announced in 2019 that it would target the federal funds rate with two other rates that it sets on its own. The Federal Reserve gives banks interest on large amounts of money kept in reserve, IORB rate, when those banks leave money in their Fed accounts overnight. Under the federal funds rate, it acts as a floor. The Federal Reserve got rid of reserve rules for banks and other depository institutions in 2016. As of 2024, that rule is still in place. Do the interest rate and the rate of inflation go hand in hand? Yes. By raising interest rates, the Federal Reserve tries to keep inflation in check. So if the first one goes up, the second one goes up too. Which is worse, loss of value or inflation? Even though inflation is bad, deflation is even worse because it can send the economy into a downward spiral that could end in a slump or even a recession. Inflation and interest rates tend to move in the same direction, but with delays. This is because lawmakers need data to guess how inflation will change in the future, and it takes time for changes in interest rates to fully affect the economy. If inflation is getting out of hand, rates may need to go up. On the other hand, if economic growth slows down, rates may need to go down to keep inflation in check. Part of how the Fed sets the rate it pays on bank reserve balances is to aim for a range of the federal funds rate. In general, although interest rates serve as a potent instrument for central banks to exert control over economic activity, the gradual manifestation of their effects can be attributed to the intricate nature of the economic system and the conduct of economic agents. When formulating monetary policy in pursuit of intended economic results, policymakers ought to meticulously contemplate these intricacies and exercise tolerance. Share your views with us and click to that subscribe button now. Thanks for watching.